This one investing rule is like a magic formula for find high quality, fast growing and durable stock investments. It fits right in the Buffett and Munger alley of quality value. Give me just short 10 minutes and I will improve your investing way of thinking. In recent years, the technology sector, especially software as a service SaaS companies, has embraced a financial guideline known as the Rule of 40. While originally designed for subscription-based businesses, the Rule of 40 has become a widely used framework across the quality value investing landscape as investors seek to evaluate whether a fast-growing company is balancing expansion and profitability responsibly. Growth without profit is a disaster waiting to happen. Though the rule is relatively new and far removed from Benjamin Graham's world of net nets or Buffett's 1970s insurance roll-ups, it intersects surprisingly well with value investing principles when used correctly. Ultimately, the Rule of 40 attempts to answer a classic question: is the company creating value, or is it burning capital to grow without economic discipline? What is the Rule of 40? It is simple revenue growth rate plus profit margin. If the sum of these two numbers is above 40, it is a very well-received sign of quality growth. Profit margin is typically measured as operating margin or free cash flow margin. Better to use the free cash flow margin as a safer and more conservative metric. Some investors like to use the net margin. The idea is that a company growing revenue extremely fast can afford to have low or negative profit margins, while a slower growing company must show stronger profitability. For example, 35% revenue growth plus 10% margin equals 45, acceptable. 10% revenue growth plus 35% margin equals 45, also acceptable. 60% revenue growth, 15% margin equals 45, still acceptable. In this case, the company is not yet profitable. I personally would never invest in such a business, but I will for sure place it in my watch list and see its progression over time, and the moment it becomes consistently profitable, this is the moment I would consider investing. For example, a 15% revenue growth plus 5% margin equals 20, which is a poor quality score. Minus 5% growth plus 40% margin equals 35. This is borderline but capital efficient. The Rule of 40 thus balances growth and profitability, two variables that investors often misunderstand when viewed independently. The Rule of 40 emerged from venture capital and growth equity investors analyzing early SaaS companies in the 2000s and 2010s. These software businesses had unique traits: highly predictable recurring revenue, large upfront investments for long-term payoff, little marginal cost to serve additional customers, potential for enormous operating leverage. Investors realized that traditional valuation metrics like P/E or headline profit margins were not capturing the full story. A company reinvesting heavily into sales, marketing, or product development could show negative earnings, yet be increasing long-term intrinsic value at exceptional rates. On the other hand, some growth companies were growing revenue fast, but destroying capital because growth did not translate to future profitability. The Rule of 40 became a quick diagnostic to identify companies growing efficiently, businesses balancing reinvestment and profitability, models capable of scaling sustainably, firms that would eventually generate real cash returns. By the mid-2000s, the Rule of 40 had become standard across SaaS benchmarks, portfolio screens, and IPO roadshows. Today, even non-SaaS companies like payments, marketplaces, fintech, and subscription consumer apps are evaluated with this lens. Several modern businesses routinely exceed the Rule of 40 because they combine strong network effects, scalable software models, and high incremental margins. Salesforce is historically one of the earliest examples. It spent years reinvesting for growth but maintained strong free cash flow margins. Its Rule of 40 performance often have ranged from 35 to 50 depending on investment intensity. Nowadays, their growth rate has fallen significantly, and due to that, they no longer follow the Rule of 40. Service now is a good example. With high subscription renewal rates and a massive enterprise footprint, ServiceNow frequently posts 25 to 30% revenue growth with 20 to 25% margins. Rule of 40 scores around 45 to 55. Adobe is another good one. After transitioning to the subscription model, Adobe's margins expanded significantly. With steady double-digit growth and robust margins, its Rule of 40 scores regularly fall between 45 and 60. Intuit combines consumer SaaS, TurboTax, with small business SaaS, QuickBooks. Its growth and margins regularly exceed the Rule of 40 threshold. Facebook, Nvidia, and Google are other phenomenal examples of the Rule of 40 in action. These companies scale rapidly with attractive long-term economics, often posting Rule of 40 metrics between 45 and 80 during hypergrowth years. A key concept to remember is that price matters. The Rule of 40 exhibits very high quality most of the time, but only buying quality is not enough. If we overpay dramatically, the end results will still be bad. Grab a copy of the full Warren Buffett style fundamentals cheat sheet down in the description or the pinned comment. It would be very useful for all investors who want to get to the next level of their investing journey. All of these examples show that companies with high retention, pricing power, and network effects can simultaneously deliver strong growth and margin expansion, key indicators of long-term intrinsic value compounding. Despite its popularity, the Rule of 40 is not a perfect tool. It has its limitations. 1. It does not measure actual profitability. A company growing 50% annually but losing money every year can still pass the rule. This is misleading because some growth is fundamentally uneconomic. This is why I wait to see the evolution of the business fundamentals. Second is, it can mask a deteriorating business quality. A company may cut investment excessively to boost short-term margins, artificially inflating its Rule of 40 score. Third is that it ignores return on invested capital. Growth that fails to earn high returns eventually destroys value. Buffett reminds us, growth without ROIC is meaningless. I have a separate video on the topic of ROIC here in the channel. Fourth is that the rule doesn't distinguish between durable and temporary growth. A firm may grow rapidly because of one-off factors, acquisitions, or short-lived cycles. Investors must use the Rule of 40 as a screening tool, not a valuation method, just like the other metrics in the cheat sheet in the description. Although the Rule of 40 originated in growth equity circles, its underlying logic is deeply consistent with value investing philosophy. It highlights businesses capable of compounding intrinsic value. Companies with both growth and profitability are the closest modern equivalents to Buffett's wonderful businesses. They reinvest cash at high returns and expand their economic moat over time. The rule filters out low-quality growers. A business growing 30% per year but burning cash is more likely a value trap than a value opportunity. Value investing emphasizes capital efficiency, and the Rule of 40 helps surface these concerns quickly. It also aligns with Buffett's quality pivot. Charlie Munger pushed Buffett toward businesses that combine growth and high returns on capital. The Rule of 40 approximates this by ensuring that growth is accompanied by a real economic gain. It supports long-term concentrated investing. Businesses exceeding the Rule of 40 often have pricing power, recurring revenue, network effects, high customer retention, scalable cost structures. These are exactly the types of businesses that value investors want to own for decades. Conclusion. The Rule of 40 has become one of the most influential frameworks in modern technology investing because it neatly captures the trade-off between growth and profitability, two forces that determine whether a business is creating or destroying value. While it cannot replace deeper analysis of competitive advantage, ROIC, or intrinsic value, it serves as a practical tool for evaluating capital discipline and economic sustainability. Viewed through a value investing lens, the Rule of 40 is not a departure from Buffett's principles, it is a modern expression of them. A company that grows efficiently, earns high margins, and reinvests at high returns is precisely the type of compounder that long-term value investors seek. Whether one calls it the Rule of 40 or simply the economics of a wonderful business, the result is the same: durable value creation over time. Subscribe for more and check out the other content on the channel. I promise it will not disappoint.